IQD Global Intel exclusive report: The Silent Reset, Vietnam's Sudden Dong Revaluation, and what it means for global currencies. 1. A shockwave in global finance. In the earliest hours of September 4th, something extraordinary occurred. A move so sudden, so deliberate, that it sent ripples across the entire financial system. For decades, many believed such a development was impossible. They said revaluations of this magnitude belonged only to speculation boards, not to reality. But in one silent stroke, Vietnam proved the doubters wrong. 2. The quiet execution: no fanfare, no speeches, no gradual signals. The State Bank of Vietnam simply reset the exchange rate of the dong against the US dollar from 23,500 VND per USD to approximately 120 VND per USD. Overnight. A single move that instantly transformed fortunes, both inside Vietnam and abroad. 3. Beyond market fluctuations, this was not a technical adjustment. It was not a temporary spike or a central bank intervention. It was a surgical revaluation, an intentional reset of a currency long regarded as undervalued. The difference between a fluctuation and a reset is control, and Vietnam displayed control in abundance. For a real event, not a rumor. For years, whispers of dramatic revaluations circulated. They often centered around currencies like the Iraqi dinar or the dong itself. Most were dismissed as myths, exaggerations, or outright scams. But this event broke the mold. It was real, verified, and embedded directly into global banking systems. 5. Why it matters: this was not simply a national decision, it was a global financial moment. Vietnam's revaluation reshapes trade balances, supply chains, and investor psychology. It sets a precedent, showing that silent resets are not only possible but executable at scale. 6. Timing is everything. The revaluation occurred at 3:33 am GMT. Why that time? Because it was a moment when most markets were quiet, liquidity was thin, and surveillance was minimal. Vietnam chose the dead of night to execute maximum surprise with minimum resistance. 7. Banking systems adjusted first. Almost immediately, banks began updating internal systems. Screens inside institutions like HSBC, Citibank, and Standard Chartered reflected the new rate. Retail-facing apps, however, remained frozen or listed maintenance errors. 8. Controlled rollout. This dual-speed adjustment was intentional. Institutional clients gained access first. Ordinary citizens were left waiting. It was a textbook example of how to manage a monetary shock without sparking chaos. 9. The first beneficiaries: high-net-worth individuals, hedge funds, and sovereign wealth entities were the earliest to benefit. Private channels were quietly opened, offering exchange reviews and controlled conversion sessions. Ordinary holders were effectively locked out until stability was assured. 10. A wealth transfer overnight. Consider this. A modest holding of 10 million VND, worth roughly $425 before the reset. After the revaluation, it was suddenly valued at over $83,000 USD. For those positioned in advance, this was not just a windfall, it was life-changing. 11. Protecting stability. Why not let everyone exchange at once? Because doing so would have risked disaster. Vietnam needed to prevent hyperinflation, liquidity crises, and trade disruptions. By prioritizing institutions, they protected both their economy and their credibility. 12. The strategy of silence. One of the most remarkable aspects was the lack of leaks. Typically, currency shifts are preceded by hints, statements from ministers, IMF chatter, or subtle policy changes. In this case, there was silence until the exact moment of impact. 13. The role of global coordination. Evidence suggests Vietnam did not act alone. Western banks had quietly prepared for exotic currency tiering. U.S. institutions updated foreign asset systems months earlier. This points to coordination, not isolation. 14. IMF clues. In hindsight, weeks earlier, the IMF had issued vague remarks about regional realignments. At the time, they seemed meaningless. Now, in hindsight, they look like coded signals to insiders. The breadcrumbs were there. Few were paying attention. 15. Hedge funds in position. Unusual clearing activity was recorded in forex markets days before the reset. Certain hedge funds and sovereign entities appeared to have shifted liquidity quietly. Those moves now look like advanced positioning. 16. Vietnam's economic case, the fundamentals support the revaluation. Vietnam's GDP growth has consistently ranked among Asia's fastest. Its role as a manufacturing hub rivals that of China. The old Dong rate no longer reflected economic reality. 17. From export hub to financial player, a weak currency benefited exports but limited Vietnam's credibility. By revaluing, Vietnam is signaling, we are ready to step up. This was more than economics. It was about national status. 18. The geopolitical context. Vietnam's move comes at a time of global supply chain realignment. As companies shift production away from China, Vietnam's role is rising. Now its currency credibility rises in parallel. 19. Regional pressure. Neighbors like Indonesia, Thailand, and the Philippines must now respond. A stronger dong makes Vietnamese exports pricier, changing competitive dynamics. This is not just Vietnam's story, it is ASEAN's challenge. 20. A new precedent. Above all, the revaluation proves one thing: silent resets are possible. Global systems can absorb them. And undervalued currencies can be rewritten overnight. A midnight reset. 1. The moment of execution at 3:33 am GMT, global banking systems quietly shifted. No announcements, no warnings, no press releases. Just silent recalibration, executed with precision. 2. Why that time mattered. The choice of time was deliberate. Markets were thin, traders asleep, and liquidity low. It allowed the revaluation to pass through the system, almost invisibly. 3. Global players in sync. Major banks adjusted instantly. HSBC, Citi, and Standard Chartered updated internal rates without delay. Their silence confirmed coordination at the highest levels. 4. Public channels stayed frozen while institutional systems updated. The public saw chaos. Apps displayed technical errors. ATMs stalled. Forex feeds flashed maintenance warnings. 5. Dual-speed reality. This created two realities: insiders with access to the truth, and the public locked in ignorance. It was a masterclass in controlled information flow. Vietnam's planners knew exactly what they were doing. 6. Leaks began to surface within hours. Screenshots from internal banking systems appeared online. The new dong rate was visible, 120 VND per USD. Disbelief spread faster than confirmation. 7. The screenshots' impact. These images ignited social platforms. Traders scrambled for explanations. Speculators finally had proof. This was not rumor, it was real. 8. Policy in stealth mode. This was not an accidental leak. It was policy executed in silence. The leaks were only the aftershocks of a controlled detonation. 9. A real-time wealth transfer. The implications were staggering. A small holding of 10 million VND, worth roughly $425 hours before, suddenly became $83,000. This was not speculation. This was arithmetic. 10. Winners and losers. For those who had prepared, fortunes were made overnight. For those who were locked out, it was frustration and disbelief. The division was intentional. 11. Universal access was denied. This was not a free-for-all. Access was carefully tiered, designed to prevent chaos. Not everyone could participate at once. Controlled access. Who benefited first? 12. The precision of execution. Unlike chaotic evaluations of the past, Vietnam's rollout was disciplined. Every layer of access was structured. Every beneficiary group was prioritized. L13. Institutional clients came first. High net worth individuals and sovereign wealth funds were the first beneficiaries. These players were invited quietly into private conversion sessions. They set the tone for liquidity management. 14. Sovereign wealth funds advantaged. These funds already held reserves in emerging market currencies. Their positions multiplied overnight. Their gains were strategic, not speculative. 15. Corporate clients included large exporters and multinational firms operating in Vietnam also received early access. Their balance sheets shifted dramatically. What was once a weakness, holding dong, became strength. 16. Private banking channels opened. Next, selective invitations were issued. Asset intake sessions were organized behind closed doors. Participation was limited, controlled, and exclusive. 17. Ordinary citizens, excluded retail customers, found themselves locked out. Their apps showed outdated rates or frozen systems. They were, in effect, spectators to their own currency's transformation. 18. Why citizens were delayed. Allowing millions of citizens to rush exchanges would have caused panic. liquidity would have evaporated overnight. The tiered rollout was designed to protect stability. 19. The message behind Exclusion Vietnam's strategy wasn't just about economics. It was about demonstrating control and credibility. The government showed it could execute massive change without losing command. 20. Preventing hyperinflation. If every citizen had converted immediately, the system would have collapsed. Hyperinflation would have destroyed the value of the new rate. Exclusion was a safeguard, not a punishment. 21. Institutional first, citizens later. By giving institutions early access, Vietnam stabilized liquidity. This allowed the revaluation to hold, not collapse. Once stable, access could slowly trickle down to retail. 22. Tiered rollout as a model. The success of this approach creates a precedent. Future revaluations may follow the same blueprint. Institutions first, public later. 23. A message to global partners. This wasn't just for domestic order. It was a signal to international markets. Vietnam can manage systemic change. It was about earning credibility beyond its borders. 24. Winners in the shadows. Not all beneficiaries were visible. Private wealth managers, hedge funds, and insiders profited quietly. Their gains will never appear on headlines, but they were enormous. 25. Losers on the sidelines. Meanwhile, small holders without connections were left waiting. They saw their potential gains locked behind digital barriers. For them, the revaluation was both a miracle and a torment. 1. Signs of a coordinated effort. The Vietnamese revaluation did not occur in isolation. Evidence shows it was part of a broader, globally supported plan. Signals were present, though few recognized them at the time. 2. Chase Bank's exotic tiering. Module Chase quietly built new internal systems labeled exotic rate tiering. To most observers, it seemed technical and irrelevant. In hindsight, it was preparation for precisely this kind of event. 3. Anticipating non-standard shifts. Exotic tiering was not designed for normal currency flows. It was meant for sudden, dramatic repricings of undervalued assets. That function now makes perfect sense. 4 U.S. banks joining the quiet build-up. Bank of America and Wells Fargo were not far behind. Both updated their foreign asset systems with hidden forex modules. These modules were invisible to retail users, but operational in back-end systems. 5. Why hidden modules matter. Banks don't build hidden systems without purpose. They require investment, testing, and legal oversight. The presence of such modules strongly implies insider knowledge. 6. The IMF's ambiguous warning. Weeks before the revaluation, the IMF released vague statements. They spoke of regional realignments and currency stability measures. Most analysts dismissed them as bureaucratic noise. 7. IMF language. As a signal to insiders, the IMF's language was a coded message. It was less about Vietnam specifically, more about preparing stakeholders. Those who understood acted accordingly. 8. Hedge funds sensed the shift. Days before the reset, unusual forex clearing patterns emerged. Hedge funds shifted liquidity in ways that looked odd at the time. Today, those moves look like advanced positioning. 9. Sovereign players involved. It wasn't just private funds. Sovereign wealth funds also adjusted portfolios with surprising aggressiveness. These shifts suggest advanced coordination with policymakers. 10. Why coordination was necessary. A revaluation of this magnitude cannot succeed alone. Without global banking alignment, chaos would have ensued. Vietnam needed partners, and clearly it had them. 11. The synchronization of banks. Consider the precision of the rollout. Global banks updated rates almost simultaneously. Such synchronization requires planning, not coincidence. 12. Avoiding arbitrage chaos. If one bank had moved before others, arbitrageurs could have exploited the gap. That would have destabilized the entire system. Global coordination prevented that disaster. 13. The secrecy element. Secrecy was remarkable. In an era of leaks, not a single credible pre-announcement surfaced. The discipline required is evidence of deliberate control. 14. Who was kept in the dark? Retail customers, smaller banks, and most analysts were left unaware. This information divide created clear winners and losers. It was not a flaw, it was design. 15. The global handshake. What happened was not just a Vietnamese decision. It was a handshake between Vietnam and the global financial system. Each side agreed to the terms of execution. 16. Trust earned through execution. Vietnam earned credibility by executing flawlessly. Its ability to manage secrecy impressed global partners. This builds a new foundation for Vietnam's financial future. Why Vietnam did it 17. Analysts knew the dong was undervalued for years. Economists argued the dong did not reflect reality. Despite rapid growth, the currency remained artificially weak. This mismatch became harder to justify. 18. Vietnam's growth story. The economy has consistently posted 8% GDP growth annually pre-pandemic. It weathered global downturns with resilience. Investors saw strength, but the currency said otherwise. 19. Manufacturing powerhouse. Vietnam has become a key manufacturing hub. Electronics, textiles, and consumer goods flow out at massive scale. Global supply chains increasingly depend on Vietnamese factories. 20. Foreign investment surged. Corporations like Samsung, Apple suppliers, and global giants expanded in Vietnam. Billions in foreign direct investment poured in annually, but those inflows were not reflected in currency strength. 21. The weak dong strategy. Keeping the dong weak benefited exporters. Vietnamese goods remained cheap on global markets. This fueled growth but limited financial credibility. 22. The credibility problem and undervalued currency made Vietnam look fragile. It signaled dependency, not strength. For a nation aspiring to regional leadership, this was untenable. 23. The strategic pivot. The revaluation marked a pivot. Vietnam declared, "We are not only exporters, we are financial players." This shift was as symbolic as it was economic. 24. Global respect earned by resetting the dong. Vietnam demanded respect from partners. It positioned itself as a nation ready for deeper financial integration. That message carries geopolitical weight. 25. Beyond economics, this was not just a financial calculation. It was a national branding exercise. Vietnam showed the world it can act boldly, silently, and decisively. Implications, lessons, and the Iraqi dinar's path. Implications for neighbors and competitors. 1. Regional shockwaves begin. Vietnam's move did not happen in a vacuum. It immediately forced its neighbors to re-examine their own positions. The shockwave was regional, not just national. 2. Thailand's challenge. Thailand competes with Vietnam in manufacturing and exports. A stronger dong makes Vietnamese goods pricier. This opens both risks and opportunities for Thai exporters. 3. Thailand's dilemma. If Thailand holds steady, it gains a short-term price advantage. But it also risks appearing stagnant while Vietnam looks dynamic. The question is whether Thailand adjusts or waits. 4. Indonesia on alert. Indonesia, another major export-driven economy, must now evaluate. Vietnam's move shifts investor perceptions of ASEAN stability. Jakarta cannot afford to appear complacent. 5. Indonesia's options. It could intervene to weaken the rupiah, or it could follow Vietnam's path toward gradual strengthening. Both options carry risk. S6. The Philippines in the crosshairs. The Philippines has relied on a competitive peso to support exports. Vietnam's bold step disrupts that calculus. It now faces pressure to rethink its own currency stance. 7. Competitive reactions. Likely if multiple neighbors adjust simultaneously, a regional domino effect begins. This would redefine Southeast Asia's economic map. Vietnam has, in effect, reset the game board. 8. China's perspective. China has long seen Vietnam as a manufacturing rival. Now it must view Vietnam as a currency rival as well. That raises the stakes dramatically. 9. China's balancing act. Beijing cannot ignore the move, but an aggressive yuan response could destabilize global markets. Its strategy must be measured, not reactionary. 10. Vietnam's symbolic win over China. Even if small in scale, Vietnam scored symbolically. It showed the world that it can make bold, sovereign moves. This undermines China's aura of dominance in Asia. 11. Multinational corporations react. Corporations with global supply chains are watching closely. Vietnam's low-cost advantage has narrowed, but its financial credibility has grown. 12. Supply chains recalibrated. Companies may shift production calculations. It's no longer just about cheap labor, it's about currency stability. Vietnam's credibility now attracts higher quality investment. 13. A trade-off for MNCs. Costs rise, but so does trust. Investors may prefer Vietnam's new credibility over short-term margins. That trade-off benefits Vietnam in the long run. 14. Regional trade imbalances. A stronger dong will affect ASEAN trade balances. Neighbors may struggle to keep pace. The ripple effects will take years to settle. 15. Geoeconomic strategy, not just policy. This was more than monetary adjustment. It was geoeconomic strategy, carefully planned. Vietnam positioned itself as more than a factory, it became a financial actor. The lesson: stealth revaluations are possible. 16. Skeptics proved wrong for decades. Skeptics mocked the idea of sudden revaluations. They claimed such events were fantasies of speculators. Vietnam just proved them wrong. 17. No leaks required. Skeptics insisted leaks were inevitable. But the Dong revaluation was executed in silence. Not a whisper escaped until after the fact. 18. Central bank assumptions shattered. Critics argued central banks always signal moves. They said policy shifts required hints and preparation. Vietnam shattered that assumption. 19. Global system withstood the shock. Another myth was that global systems couldn't handle sudden resets. Yet the system absorbed Vietnam's move without collapse. The world kept turning. 20. Proof of concept. The Dong revaluation became a proof of concept. It showed that silent resets are feasible. It rewrote the rulebook of modern monetary policy. What this means for the Iraqi dinar. 21. Attention turns to Iraq now. Eyes shift from Hanoi to Baghdad. If Vietnam can do it, could Iraq follow? The speculation grows louder. 22. Years of dismissal. For years, the Iraqi dinar was dismissed as a fantasy. Critics cited instability, corruption, and weak institutions. They claimed a revaluation was impossible. 23. Vietnam changed the conversation. That dismissal no longer holds. Vietnam proved revaluations are not just rumor, they are reality. The IQD now deserves a second look. 24. The blueprint exists. Vietnam provided the blueprint. Silent execution, global coordination, institutional prioritization. Iraq could follow the same model. 25. Iraq's unique advantage. Unlike Vietnam, Iraq sits on vast oil wealth. Its reserves provide natural backing for a stronger currency. That gives it leverage Vietnam never had. Risks, new era, and the road ahead. Risks, opportunists and scams. 1. The shadow side of big moves. Every seismic event in finance attracts shadows. Where there is sudden wealth, opportunists rush in. 2. Scammers thrive in chaos. Moments of confusion create openings. Fraudsters use urgency as their most powerful weapon. 3. Special access promises. Already, fake offers are circulating online. Claims of secret exchanges are designed to lure the unprepared. For the old playbook returns. This isn't new. Every revaluation rumor in history has spawned waves of scams. 5. IQD Global Intel's reminder: legitimate exchanges occur only through licensed banks. No exceptions, no shortcuts. 6. Brokers versus pretenders. Authorized brokers operate under strict regulation. Private sellers on Telegram or WhatsApp do not. 7. Scams spike during transitions. Fraud rises fastest during moments of uncertainty. We are in one of those moments now. 8. The trap of urgency. Scammers will say, act now or miss out. That phrase alone is the red flag. 9. Discipline as defense. Your strongest protection is discipline. Patience beats panic every time. 10. Verify before you act. Check licenses. Confirm official bank channels. Do not trust screenshots or hearsay. 11. Opportunists exploit hope. They know many holders have been waiting years. Hope becomes the lever they pull. 12. Don't let hope become a trap. Hope is good, but hope without verification is costly. 13. Scammers love social media. Fake groups, cloned accounts, stolen logos. These are their tools. 14. Banks don't DM you. No licensed bank is messaging you on Telegram. If someone does, it's fraud. 15. IQD Global Intel Rule 1. If it sounds too good to be true, it is. Always, without exception. A new era of monetary strategy. 16. Beyond Vietnam's numbers, this was more than a rate change. It was a shift in psychology. 17. Finance proved flexible. Global finance absorbed the shock. No collapse, no chaos. 18. Quiet resets are possible. The old belief was wrong. Yes, surgical resets can happen silently. 19. History in real time. We just witnessed history, not in headlines but in hidden screens. 20. Trust rewritten overnight. Vietnam showed credibility can be rebuilt. One bold move erased decades of skepticism. 21. The first domino. This was not the end. It was the beginning of a chain. 22. The stealth model. Silent, controlled, coordinated. That is the new model of monetary shifts. 23. Iraq takes notice. Baghdad is watching, so are other undervalued nations. 24. Africa's hidden players. Currencies in Africa are undervalued too. They now have proof that revaluations are possible. 25. A playbook emerges. Vietnam gave the world a template. Others can follow. Conclusion, the road ahead. 26. What made Vietnam different? It wasn't just the new rate. It was the way it was rolled out. 27. Silent execution. No leaks. No rumors, just action. 28. Controlled access. Institutions first. Retail second. Orderly and deliberate. 29. Global coordination. Banks worldwide were prepared. This was not a solo act. 30. A precedent for Iraq. For the first time in decades, precedent exists. The impossible is now possible.